Oh, right. Morning, everyone. It's Hot Stocks. I'm live here with Paul Hill. He's full of viz, full of energy. But I did see, Paul, you said you've had a hard week. That's the nature of the game, isn't it, at the moment? But welcome along, everyone, before we start. It is live, so I do encourage you to comment anything you want to ask, any comment, anything at all. As I say, no question is a silly question. Well, we can be the judge of that, but at least put the question in there. Join us there. Hit that subscribe button as well if you could. But we're covering some stocks, some investment ideas. Not all ideas work out, especially in the bear market. But Paul, so what do you want to start with? Macro, micro? What, up to you, fella.
Well, yeah, just on the silly questions, I think we've got sort of like plenty of them coming. That's for sure. Just me and you. But no, I thought it would be worth just. I mean, I've had a couple of profit warnings this last fortnight. Certainly this week, I had a couple. I had one on I think it was Monday, and then one on Tuesday, and stuff like that. And it's what's important is how you react as an investor. And we've got a full position first of all in inspiration healthcare, and then a smaller position which I bought in after the profit warning into Argentex. So it hasn't been good, but just coming back, how to handle profit warnings. And it's clearly an emotional perspective, but you have to sort of like then step back and look at sort of like the actual business and what's actually been, caused it, etc. And just take, say, inspiration healthcare. I've got a full position. This one does neonatal baby warmers and ventilators. And it'd been doing pretty well. It'd been tracking up on the back of a good deal out in the States with its distribution. It'd been generating cash throughout this whole 2023. And it was slowly making good progress. Of course, it's a high IPR type business with lots of sort of like, good relationships across the industry. And it's not easy to get into this because it's life and death for babies, you see. So there's big barriers to entry and, sort of approvals and all sort of stuff. So there's lots of good sort of like, attractions to the case, not only from the company, but also the industry, and also the valuation's pretty cheap. It's about sort of like 7 or 8 times PE. So it was all tracking up, going well. Anyway, they came out with this real shocker on Tuesday, I think it was, or Wednesday. And they basically said they were going to be short on sales largely due to a large order out in the Middle East, which hadn't shipped before the year end in January 31st, which was going to impact not only their profitability and top line, but also more importantly, their cash flow, because they'd built up a whole lot of inventory for it. And therefore, they actually just technically breached their banking covenant. So they were looking for a waiver for their lender. They managed to get that yesterday, which was good news. But clearly, the shares reacted badly. So you have to take a step back and say, is this going to be is this a reason to sell? And when you break banking covenants, it's pretty close to the line, to say the least. And therefore, you have to sort of say, well, okay, is the bank going to stand by this? And given that they've been doing sort of like 2 steps forward most of the time, then this massive jump back is something which is very painful. But I'm actually going to hold the position. And that's the rational approach. Now it comes down to sort of sentiment and stuff like this, and that's how really investors need to look at themselves and say whether are you a sort of like a technical investor, which would break your 200-day averages and your 50-day averages, or are you a long-term investor? And my fundamentals overweigh the technicals. I mean, as you say, I'm not a great fan of technicals, but regardless of that, I think this business has still got legs, but it could well be, this is a sign of more difficulties ahead because the market is a bit more sort of challenging. I would point it such that, I'm hoping that this Middle Eastern order can get delivered. And assuming it does, then we should be absolutely fine. But that is a big question mark, and you've just got to accept the risk. And that's part and parcel of small cap investing. You have to roll with the punches and, take a few hits. As I said many, many times before, my hit rate is only 62%. And this is one of the 38 that, I've had problems when. You just got to basically just accept it. And regardless of the pain, you've got to be prepared to be wrong often if you're investing in small cap land. So that's my view on inspiration. But I thought it'd be worth highlighting because, there's a lot of good principles for small cap investors. I don't know what you think there, Justin.
Yeah, listen, in the bear market, profit warnings. I did actually do a taking stock on this, and it was a bit disingenuous. But I said how to avoid profit warnings, and I think in a bear market, what you don't want to do, you want as much information about how the company's doing as possible. And I said, if you're thinking of taking a position and a trading update is coming out, or final results coming out, don't wait. Because you've got to do really well within those trading updates to make it rally. Because in a bear market, you can go down like 30% in a day if it's below. So I would just say, just wait for results to come out. It's better to have a company go up on good results and have a bit of patience and get in a bit later when it comes down a little bit, rather than jump in beforehand and then take a 30% hit. And so I say, first of all, have patience in a bear market. You can afford to take time to do more research. And secondly, it's like, there's many things. I look at when I look at it researching, I'm looking at what to invest in, how to invest in it. When to invest in technical. So the what is fundamentals always comes first. You should always look at growth, value, all that, health, efficiency, and then I'm also looking at look at the chart as well. But if those two things go wrong, right, the only protection you have is portfolio management. That's the only controllable you have. You can't control the management, the operations, anything. The only control you have is how much money you put into a company and what diversification you have. That's the only controllables you have. So you have to look at your exposure to this company and think worst case scenario. Because it does not often play out worst case scenario, but if you plan for worst case scenario and it doesn't impact your portfolio, you're fine. So I've taken so many hits, and I was very sort of concentrated on small caps. I've changed a little bit in this bear market, and I've learned so much in the last few years that I've learned ever, I think. But I will not now go big or on initial investments. I will literally put maximum 3% of my total portfolio value into it. If it takes a big hit, it's fine.
Yeah.
If it starts going in the right direction, they start coming up with future reports that are very good, I'll average up. I'm happy with that. But I want to leverage towards winners, not losers. And so that's what I do. So it's essentially, and I think now what I'm scanning for on a daily basis is companies exceeding results. Because I know then they're on good track. So I don't want to be hit by surprise, and so I'll be more patient. And so it's a combination of those factors: portfolio management, but also looking for positive news, consistent positive news from companies. And I don't mind if I grab a company that's gone up 20-30%. What I don't want to do is be taken down by 20-30%. So that's my
yeah. I mean,
thoughts on it,
I'm a bit more broad-shouldered then in that case, because we've all been hit in the past, and I've been hit just as badly as you a lot of the time. And you've just got to be. I think you've just got to be prepared that this is a probability game, okay? And that's the hard bit to get your head around, is that you're going to be wrong often, and you can, and if you accept that, then you'll realize you're right twice, but wrong a third of the time out of three. You're right 2 times out of 3, but wrong a third. And if you're prepared to accept that basic philosophy that you're going to have 2 steps forward, 1 step back, but overall you're moving in the right path over the long term, then you'll get through it. And I think it's been, don't get worried about the short term trying to time the market about when you're in and when you're out. Look at it on a rational basis and just accept, you're not perfect. Nobody is, and you're gonna make mistakes. And
but hang on a
second.
What I'm saying is you are going to make mistakes. That's exactly it. Now, how do you mitigate that? And in my mind, you keep those mistakes small. So when you make an initial investment, don't go big. Don't think it's the one, because every investment I make, initial investment, I think it's going to be the one, and we all have this, literally subjective view on it. And once you are in a company and you have money invested, you are biased, and you've probably focused on the story of what you want to be rather than what it is going to happen. So I think if you know you're going to make mistakes a third of the time, keep it small. If it goes right, you can always build. But what you don't want is to go big into a company and make a mistake. So portfolio management, is risk management essentially. And so as I say, that's the one thing. That's the one guarantee in the markets. You're going to make a mistake. You're going to take a hit. It's going to happen. But don't make it big, and don't take it out of the game, because
I'd agree with that.
Size
it appropriately.
Yeah,
absolutely right. Yeah. Okay, another one I've taken a bit of a hit on it. I've got smaller position because I didn't have much cash. I've just really sort of recycled dividends. Is Argentex. And
I didn't realize you were in there. You were in this recently, were you?
I came basically after the last profit warning. I had a few dividends that I just pushed. I mean, we're talking small position in this because I just haven't got much money. Anyway, I popped in originally about 60p. It went up to about 95, and has come all the way down. And what it did is it had a profit warning on Monday, I think it was. And I'm pretty sure the base at about 50p, there was sort of like 4 million odd shares which are traded. That's either a large fund manager or probably one of the founders. It's probably, I'm just guessing here, and I really don't know because, but it could well be, Harry Adams, the ex-CEO, who's got a lot of shares. I think Rockwood Strategic have picked up a big chunk of that at a very, very good price, Richard Staveley. So I topped up, we had some more spare dividends and therefore topped up again at around, I think it was 62p or something like that after the announcement. But again, I come back to it. You've got to basically look at the fundamentals and say, is this a broken business, or is actually got a good long-term future? And I think it's the latter, because they've got a rock solid balance sheet. They've got good customer relationships. They're still profitable, generating a lot of cash. They've got say plenty of net funds there at the end of December, and they can invest into their tech platform and overseas. So I'm pretty confident in 12 months' time this will be a lot higher. But again, you can just get spooked out by you short term. I don't like, the technicals are not looking good, or alternatively, you say, well, it's got to be increasing financials and all this sort of stuff, and you can miss some really good bargains. And I take the more broader picture, such that if it's got good fundamentals and it's put out a profit warning, then actually the downdraft, when people are distressed selling on emotion and on it's broken the technicals, then you can pick up good long-term positions on the proviso that you don't oversize, which is what you've said, and you're wrong. So, quite, a third of the time. But if you're right twice out of three, then actually you're going to do pretty damn well, which is what often the case is. And that's why, neither I've actually topped up, as I say, in Argentex, and I didn't sell my Inspiration because I think the long-term fundamentals are still there, albeit I do accept there's a lot of risk attached to both the businesses, and it doesn't necessarily I'm right, and I'm not happy about it. I've lost a lot of money. It's not portfolio down quite a lot. I mean, a small position for me is probably a big position for a lot of people. But you've just got to accept it. And I've been through this many times before. And as I say, the reason why I've raised profit warnings this morning is I'm sure other people are going through the same process with their own stocks and their own portfolio and deciding what to do. And it's a personal decision, clearly. But you just got to accept that profit warnings are part of the game of stock picking. And I reiterate again, you're going to be wrong often. And you've got to get over that. If you don't get over being an idiot a third of the time, then you'll never invest and you'll never make, hopefully some very good long-term capital gains.
Yeah, I looked at it on this. Someone request to have a look at this on the webinar I do on a Wednesday at the Investment Club, and it's good value. Good value here. The only concern I said, this is definitely firmly on my watch list because I did have this previously, and I said, what you want, of course, is a small company. It should be growing as well. At the moment, I mean, it's flat year on year from things. So that's the issue. I mean, can they grow again?
It's not an issue though, Justin. It's only an issue if you put the rails on that it becomes an issue to you.
Well, no, it is an issue. If they're not growing and the top line's going down, where do you think the share price can go?
No, that's history. That's history, though, Justin. You've got to look at what's going forward.
I'm looking forward.
No, it isn't going down going forward, though. I don't understand how are you getting the leaping from history to future.
Well, hang on a sec. So they put out a statement saying their revenue is flat, right?
Yes.
Going for so, of course, forecasts are forecasts. What's the growth forecast in this? Because it's a growth stock.
The industry's growing at high single digits. Sort of like at low double digits.
Yeah, but they're flat.
Yeah, I know, but how are you putting on the assumption they're not going to grow going forward when they've grown in the past and they've had a difficult year with the management change?
Well, exactly. If the industry is growing, I mean, look at something like CSFS, right? Growing at an amazing rate, right? Yeah. I mean, so how is it Argentex managed not to grow in an industry that's growing?
No. So coming back to the bigger issue, you put the rails on that you wouldn't invest because of its historical side, and I say I actually don't want those historical rails because that'll make for me personally, my personal
You've got to
decision.
look at how the business has been performing. You've got to see, and what's the point in reading any financial report? Because they're all looking backwards. We're not fortune tellers. We're not forecasts are just that. They're forecasts. They're where they want to be. I mean, based on certain facts, but they're not accurate. It's like a weather forecast. The further are they out, the less accurate they are. What's actual fact is what's happened, and what's happened is they've underperformed.
Yeah,
So, we're
you.
hoping that now you're hoping they'll turn that around. Now that's a hope. That's not fact.
Okay. Right. I personally, rightly or wrongly, invest in the future. I don't invest in the past. I look at the past.
Of course we all do.
No. Don't interrupt. Don't interrupt. I look at the past, okay, and say, okay, the mistakes, is it temporary or is it actually, endemic within the business? And then I reach my own view on the forecast and I weight my opinion on the company and the stock price probably three quarters in the future and about a quarter in the past, okay? And that's how I view it. And therefore putting too much weighting on the history, which could be just a temporary issue, it will constrain your decision making. And that's why I don't put those rails on, i.e. such that I want to meet my own view rather than having arbitrary rules that somebody or somebody puts on for me, you see.
No, I understand that. But like I said, now, whether you like it or not, you're invested. You are biased in that company, so you wanted to grow and you wanted to improve. You don't know that, like you said. You think, and you're using probability. It's fine.
Yes.
Now, if you're very conservative in that, it's fine. But again, it's just an opinion. Now, figures are fact.
It is an opinion. Yeah.
Opinion is just that.
That's investing, though, Justin.
No, I know, but the thing is, if it's not improving, right, and they don't get, we all know turnaround stories or readjustments of the business is going to take a long time, and they never run smoothly ever, and that is through experience. You know that as well as I do. So yes, we're hoping someone will come in and turn this around and get it, get the growth going again. But I mean, I think is upside here definitely looking at, and I put like 10% just next 2 years. I mean, that's what I'm thinking, and that's what I'm hoping. But I mean, unless they come out and confirm that in a trading update somewhere, if they just say, oh, it hasn't improved, what do you think is going to happen to the share price?
Yeah, okay, but if they do, okay, then the shares have already moved. Then the shares will have already moved. I mean, hey, we have different views at all how we invest, and I as I say, I'm prepared, to make my own view earlier than being confirmed by an analyst deciding to put some numbers on the table, okay? And I accept I'm taking a bigger leap of faith about my own personal view. I'm putting a greater level of weighting onto my personal view, which drives my personal investing, than you're prepared to pay. And I accept that. It's really not a problem which is, just the way it is, just the way I do it. But that's how I look at profit warnings. And whether it's an opportunity, I rarely double down on if it's a position, only where I think there's real. I mean, I actually think at these current levels, there's an 80% chance of making significant amount of return over the next 2 or 3 years.
But with that 80%, what's it based on? I mean, you just picked that from the sky.
Just a pure, and I wouldn't even view it as an opinion, because I'd put opinions have stronger views. I'd put it as a feel. That's my feel that I think is 80%, okay? And there's nothing more than just basically finger in the air and saying that's from my personal experience. And I could be wrong on it, okay? I definitely could be wrong.
Well, I know, but you are a numbers guy, a figures guy. You're an equity analyst, and you're saying that's your finger in the air opinion. So, yes. I mean, surely you should base it on something more solid than that.
No, you can't, because you
well, why? But the thing is, you know full well, right? This is what I'm saying about profit warning. If you have a company with a profit warning, stay clear. That's what I'm saying, until you see some, because they can continue for a while, and they don't come in singles, or they come in 3s and 4s. And in fact, a stat without, do you see more profits warnings were issued in the last year than in 2008? And generally, I think it was a ridiculous stat saying most companies issue 3 or 4 profit warnings. So I would wait until there's some stabilization here.
That's fair.
That's fair.
I get
and likewise, and also, on the opposite side, if you go with companies actually exceeding, they're more likely to keep exceeding. because and especially from a recovery play, because it takes a long time. That's where to play it. Wait until if you want to something like this now is a recovery play. All right, it takes a long time to recover. So wait until they start coming up with better figures, better numbers. It won't have moved that much, honestly. I mean, if it does, then your downside risk is removed because they are now improving, and so there'll be upgrades going forward rather than downgrades.
Yeah.
So I think if you're playing it on that in recovery plays, profit warning companies avoid. Sit back, put them on a watch list, and that's it. Because
I agree. It all depends on how you want to run your portfolio.
I want to make money.
Yeah, I prefer to invest in what I think are even better opportunities, and I don't particularly want to be handcuffed by that rule of just buying stuff that when it's going up on a better profit warning. I just don't, because the best investments I've ever made are ones where it's been totally disliked by the city and very few people want it, and there's a lot of technical selling as well.
I agree with that. I can be. I mean, literally, when companies are out of love, but you have to understand that, they have to be improving fundamentally from where they've come from, and then the chart will reflect that as well, pretty much. Because if they're deteriorating still, they're going to go down. The share price is going to go down. So it's almost like I know lots of companies we can mention that that they've got loads of followers, right? Yeah. And I say generally when you get companies that have got loads of followers, they never do any well. Do you know what? Because it's all priced in. All the hope and hype is priced in. Most companies that do well are not loved. They're not well followed. They're overlooked. And so you have to, but it's like I said, you can go through, I can research literally 20, 30 companies. I'll probably find one that's, I think, wow, that's got decent potential. And but I just think in a cycle, it's about downgrades and upgrades, isn't it? Where you want to stop is where they stop downgrading and they come up with, okay, it's not getting any worse. It's not getting any worse. And I don't mean improving, but it's not getting any worse. It's likely to get better. That's the sweet spot, because it's been forecasted, it's been downgraded so many times, and all of a sudden, hang on a sec, it's turned. And that's where, and it is upgrade cycle then.
I'm more of an independent thinker then in that case, because I'm not prepared to wait.
Don't say that. I'm an independent thinker.
I'm not prepared to wait.
I mean, you can't just say you're independent. I'm an independent thinker. I go through several stocks a day researching companies, and I pick them not on forecasts, but a multitude of different metrics. It's not about being an independent thinker.
It is.
To be a stock picker, you have to be.
Just let me explain then, okay? If you're being swayed by whether it's going to be upgraded or downgraded by analysts,
I'm not saying that. I was just part of
you said upgrades and downgrades.
I said it's part of the picture. Part of the picture.
Right,
I mean, there's many things to look at.
Well, maybe we are closer then.
If I get a company that's upgraded, I won't buy it. I've seen a couple this week been upgraded, but I won't buy them. So.
Okay. Well, we've had a good debate there, and it's quite interesting how we both approach it, because you would have not got into any of those stocks with profit warnings, whereas I'm prepared to take it and hit it, and I've got it wrong, and that's just part of the game. So that's an interesting approach,
and it's about getting it right. It's about earning money, isn't it? It's about making money. That's what it's about. It's about getting a return on your investments. I don't want to sit on a stock that'll be down for like 6-7 months. It's like it's inefficient allocation of capital. That I want to put it somewhere where it'll go up in a shorter space of time. That's why you should also go small to start off with, because we've been in this game for a long time, and you can be convinced on a stock and you think it's going to go crazy, and all of a sudden it doesn't for some reason. You can sit there bumbling around for like 6 months or something. So I will then never increase my exposure to that, because if I got 10 stocks, 10% each, for example, and I go all in on all of them. Okay, and then it's underperform. It's pointless. If I got 3%, I can hold quite a few more stocks, and have cash on the side, and then leverage towards the winners. Get your portfolio, leveraging towards the winners, and it's just efficient allocation of capital.
Yeah, I mean, as I say, I look at it further than 6 months. I look at it 3 to 5 years.
I want to hold companies for. I want to hold companies for as long as they perform.
Yeah. Yeah.
I don't
okay. Well, let's move.
There's no point saying I'm going to hold this for 3-5 years if it's not performing. I mean, I'll hold as long as it performs. It does them out. And full stop. I'm out. Companies are a vehicle to
the reason I
it's my own business. If it's my own business, fair enough. I'm loyal to it. But if it's a business I invest in the stock market, unless they're actually performing and giving me a good return on my capital, why should I hang around there?
Okay.
Get out of it.
I view it 3 to 5 years, okay, because that means I'm prepared to take and roll with the punches because I know it's not going to be a straight line up and down, okay, and
Never is,
therefore I take a longer term view about the intrinsic worth of the business and its opportunities. So anyway, let's move to another one because
I think it's good. But let me just say one thing. I think that Argentex is firmly on my watch list, and I like it. And I think if they even achieve like 10% growth from here, it could be really good. And so I'm liking it. But at the moment, I just want more information on it. Because there's a lot of turbulence in that boardroom. Whatever's going on there, no one seems to know what's going on. And I just think at the moment, and of course, opportunities can arise in situations like that.
Okay, well, that's a good place to agree on. Okay.
Yeah. And everyone put Argentex in your watch list. I'm sure they've got they'll get someone in that'll sort it out, and it's a good business anyway. It just needs, like I said,
Okay, well, let's move on. Let's move on to my top pick for 2024 and 2025, which is Eleco, which came out with a trading update. Okay, and it basically, as I was hoping, as I mentioned last time, it has been transitioning from its sort of perpetual license model to a SaaS model. It's a software company in build tech and visualization software. It's got really good customer sort of links with Mace and McCarthy and Stone, and it's done lots of iconic buildings and big project management type sort of initiatives and stuff like that. So it's been going through this SaaS transition, which has artificially depressed its sales, and now it's reached a bottom, and it's actually now starting to see growth. And I actually think this business is in a really excellent position because it's generating good cash. I mean, you just see that from its stacked up on its cash balance, 10 million or so. And what was quite interesting, actually, it put out its trading update with record recurring revenues now of about 75%. And clearly the macro side is not brilliant. And it says that despite challenging macro climates and geopolitical certainties. Well, I'd highlight to investors, have a look at the video that I did with Jonathan, the CEO, because he when I asked him first off, what was the build tech industry like at the moment? And the word he used was buoyant. So there's plenty of opportunity there. And because really the industry needs their help. There needs to be able to manage the costs, the timing of big projects, big flagship projects, and more importantly, all the ESG and the energy consumption and all this sort of stuff, and the management of their staff with tight labour markets. And they've got a great opportunity out in the States as well. So it's all on track. The shares have ticked up. They're still not expensive, though. They trade at just over 2 times sales, but I think they'll exceed their expectations going forward. They're on I think it's about 20 times PE, but frankly, I'm pretty sure the analysts will be upgrading those numbers. And if you look at it on a sort of like a peg
Don't worry about analysts upgrading. Don't worry about those.
I'm not. Because I've invested before. I'm not.
No, listen. I want to show you something.
If I was worried about it, I wouldn't be invested. But this is actually my second biggest position, Justin. I'm not worried about analysts.
Listen to this. I'm talking about good news and bad news, okay? Go for companies that get good news. This is back in January 2023, all right? Yeah. Last year, over a year ago. Look at what they released here, all right? When then we look at the chart. So, analyzed recurring revenues, 18 million, up from 16. Total recurring revenues, okay? That's increased 64% total revenue. It's all good news there. It's all good news. Cash generation remains strong. That's January 2023, okay? Let's look at the chart. January 2023 is at 70 pence a share, almost a low. So the thought that the companies go crazy on good news, it's not the case. And then it started rising. So if you keep an eye on trading updates and like I said, it rallied. So that's what I'm saying is try and edge towards company releasing good news. Businesses are improving. And Eleco was back in January. They were saying there's good stuff happening here. And
good. Okay, we're on agreement again then. Fantastic. And
and that's 12 months ago, and now it's like 96 pence. Yeah, like I said, it that thing. Obviously, a seller coming in.
Yeah. Well, I'm glad. Put this on your watch list then, Justin.
Yeah.
But anyway, coming back to the fundamentals and the valuation, it might optically look expensive at about sort of 19, 20 times PE, but the PE, the E is going to be increasing at 25%. So if you do it on a PEG ratio, it's less than 1. Which I think for a quality company with a rock solid balance sheet, with a really good, story on the SaaS side, and with 90 odd, near 90% gross margins, I think this is a really, really good value business. And as I said before, ultimately, I'm pretty sure one of the bigger players is going to take it out of Bentley Systems, or somebody like that will run the right slide rule over it, and it'll go out about 150, 160 or so. But I'm really happy with the position. They're in a good market, good solid business, and it's the second largest position. I've held it since 2015, and I could have been shaken. Well. I could have been shaken out many a time, but again, I look at it as a long-term view, and I'm prepared to go through the rough and the smooth, and that's really the essence of what I've been trying to raise, to highlight to investors. You've got to be prepared to be smacked in the face, and then what do you do? Okay. And you run back to the financials and you just say, well, this for me personally, this is an occupational hazard. When I get problems or things go up and down against me, then you've just got to accept that happens in life, and it happens more so in stock picking. And that's why most people can't invest their own money, because they can't handle the emotions. And if you can't do that, you could be Einstein and miss the opportunity.
Yeah, but I mean, listen, most like I say, professors of economics and all that stuff, they don't make money in the stock market.
No, they don't. Not even Einstein went bust.
I know. It's largely an emotional thing. Like I said, the only difference between a good investor and an average investor is emotions and discipline. That's all it's about, And but in fact, I tell you, just had an alert on Paul. I think you still hold them. It's quite good. Do you still hold GB Group?
Yeah.
Look at this. We share this. Look at this.
Oh, wow.
High.
Okay, that's nice.
Recent high, right? This is now a golden cross has happened here. I think for the 50-day moving average on. But here we are. Look at that. So
have they come out with any announcements?
No, just
no. Okay. All right. Well,
look at that there's previous high pretty much. I can't see my head's in the way here. Let me just move that. Previous high there of 283 is going to 290. We've also got the golden cross here. You can see a series of lower highs. That is looking good. GB Group, and
well, they came out.
You explain what they do actually. Yeah,
they came out with a trading update only a few days ago, and they do identity management software that helps retailers make sure that the person they're selling to may have age verification, may have the right location to actually send the product to, and is the person they're actually saying they are. They're not an imposter, or they're not doing credit card fraud or anything like that. And that's where they're sort of bread and butter. There's only 4 companies in the world that do this properly at scale and can be relied on, and they're one of them. So they really are a bit of a crown jewel here. They are the only sort of like independent. They actually did get a bit of a takeover sniff in September 2022, and you can probably see it about £5. Then when you look at the numbers, they're not that cheap in terms of the fundamentals. But if you look at it more so that they've gone through, they got knocked by the crypto craze when it came down over last year, and they've got through that, and they're seeing growth in not only online, which is clearly what is happening, but also in in gaming, and they're also doing quite a bit of into online gambling out to the States and stuff like that. So I think the underlying fundamentals are improving, and I think the guy also now coming in as the new CEO is an AI expert, and this is an area of significant growth because with the amount of imposters who are going to be able to put in the software, then they should really benefit. So I would say it's not cheap in terms of the fundamentals. And you look at the analyst forecasts who have not upgraded at all. In fact, if anything, they've nudged it down. Yeah, I got in before that, knowing that actually looks like it's too conservative. I think we're going to beat the expectations ultimately because we'll have higher operating margins than at the trough level. And so I've got in before, and the shares have done well. I would still say it's in my, the reason why it's not a slam dunk in this, to me, is simply because the pricing, the valuation isn't that cheap at the moment, and they haven't yet really turned the corner in terms of, getting into the final sort of promised land of AI generation. So, it's still got to prove that it deserves a much higher valuation. But hey, I'm there for repeat again. I make my own views in terms of, without analysts, and some of them are right and some of them are wrong, and this could prove to be right or it could prove to be wrong ultimately. I don't know, but I'm prepared to hold it for 3 to 5 years. But it's nice to see it is moving up. But does it make me particularly any happier? Yes, a bit, because you feel as though you've made a bit of money, but the fundamentals have still got to catch up.
Yeah, no. Well, listen, when you highlight this to me, and they didn't have an impairment that took it down massively, and like I put it through spreadsheets. What the hell? That's dreadful. And I scored the lowest on my stock
Yeah.
score thing. And then you mentioned again. I looked into it and I did some research. And I quite liked it. I saw some interviews you do with fund managers on it, and I thought, this market is only going to get bigger. And what I don't people, most people understand, if you look at their client list, it's the who's who, massive clients. And if you are doing any online verification, they're probably behind it, or any website. And, most of the big websites will use them. And like I said, they've got some massive clients. And like I said, the fact they're going to be taken out for £5 shows they got something special. And sometimes, like you say, it's investing is it's not a science. It's like I said, the valuation they're not cheap by any means.
No.
But you think if you've got a world-class asset, sometimes like a very good business, it's not going to be cheap. It's not. It's like the best businesses aren't cheap. That's it. And so sometimes you say, is it worth that? I think maybe worth more than that actually, because it's yeah. So I do like this, and
the other thing you need to think about when you've got sort of like software companies or healthcare companies, the gross margins on these things are very attractive. Okay, the barriers to entry are pretty big as well, because people don't swap these things out. It's high recurring revenue streams, and on that basis, there can be a massive disconnect between private valuations and public valuations.
Yeah.
And lots of investors, I'm sure, hear this thing and they don't really understand it. And the reason why I say it, okay, is your public valuation, what's listed on the stock market, it tends to be valued off earnings, right? And that's after all the overheads of a listed business and, head office and R&D and all this sort of stuff, okay? Or G&A and sales and marketing. But in a private market, so when it's bought off by somebody, they take everything below gross margin away. They eliminate it, so they can pay a multiple really of gross profits. And yes, there might be some extra costs they need to put in with integration and buying the company out and all this sort of stuff. But it's a totally different animal when you do a roll up or you take it off on private. You just strip out so much cost, and that's that's another good learning for investors. Put it through the private market's eyes about if this is a trophy asset or something really quite unique. It makes high gross margins. Then frankly, somebody who wants to buy it and integrate it in their existing business can generate a shed load of money and and price it at a difference and still do really, really well. And that's why a lot of public companies, particularly who are rich in IPR, GB Group being one, can be bought out at £5.
Yeah. No, I just think if you look at the end markets, like they're in, it's only going to get more busy for them. I think like I said, everyone lives online now, increasing location, verification, fraud. It's going to get it's going to get more complex. I say AI is going to create a whirlwind of problems. Absolutely. So I think they're well placed to benefit from that. And
it's creating a world of problems for me as well.
Yeah, I know.
just on my point. Anyway, yeah, let's just sort of tie a bow on the M&A theme, because we've got equals as well. Just worth mentioning that. It basically, because last time we were saying, well, what's it going to do? It was waiting for its put up or shut up for I can't remember, it was the something like the 27th, I think it was, of January, or 29th of January. Anyway, they've had to push it forward 4 weeks. So it's been extended again, and it's much of the same sort of messaging as before. There's clearly a lot of interest between, there's clearly a lot of interest from Madison, Dearborn, who are the prime candidates. I don't know whether there's anybody else in there, probably not. And the shares are just sort of tracking where they are. They also put an inline trading update out as well. So it's just really wait and see where we get to. But on the M&A, coming back to what private valuations, these make sort of 50% gross margins, and they're a platform business. So if you've got a roll up, in terms of, private equity like, Madison Dearborn have, and they integrate it with somebody else, there's lots of synergies they could generate and therefore pay a higher price. And I'm sure that's what's currently the sort of like the area. They're debating on what price to put on the table. You just got to wait for it, really. But no real change other than, hey, it just says to me that there's real genuine interest, and regardless of whether it does go ahead and it gets agreed at a certain price, if it doesn't, then I'm not massively, perturbed about it, because the longevity and the growth trajectory of the business is very good. And as I say, I've held these now for nearly 4 years, and I could easily hold them for another 3-5 years. Why not?
Yeah. Comments here. Ross says AGFX is at the price where it doesn't need to grow very much at all, just needs to avoid a significant decline in the coming years. Yeah. No, I agree.
Good observation. Well done.
Yeah,
Tell that to Justin.
No, but if they come out with news that they aren't improving, it'll go down. Don't worry. But hopefully that won't happen though.
Yeah.
Let's hope. But Laconic said, but figures are fact of the past. You're still hoping it predicts the future. Yeah. Love the arguments from you two guys. It's not arguments, discussions. But loads of ways to make money in this market. Think both your views are equally correct. That's it. But they fit your personal.
That's very politically put.
No, but absolutely. I mean, it's almost like, I keep saying this. If you look at an international football team, there are 11 players on there. They all have different styles. They're all world class.
Yes.
Like me and Paul are world class.
You are. I'm not.
No. It's a contrarian versus momentum argument, really. Okay.
Another one on this sort of the corporate side, just worth mentioning is Verici, and they're basically doing a fundraise at the moment. I mean, there's nothing other, I know anything other than what's publicly available. They're doing about £5.5 million raise, real top up sort of stuff at 9p, to continue investing in their kidney transplant diagnostics technology or platform. They've got the Clarava, which is a pre-operation test. They've got the Tutivia, which is a post-operation test, and they've got Protesia, which is a further sort of 6 months, 9 month test to make sure that the kidney being transplanted is still operating properly. So they're doing exactly the right thing, and I thought it was good that Christopher Mills, who's Harwood Capital, is has backed it as well. And we all know that they've got that really good big deal with one of the global pharmaceutical diagnostics business out in the States. So I've mentioned it before, the CEO Sarah Barrington is absolutely top notch, and she's built a good team there and unlimited resources, and she's doing a really good job. So just keep backing the management team is what I'm going to do, and let's get I think they've done the placing, and it's a matter of sort of getting the final retail offer sorted and the AGM sorted, which is about the 20th of February. So just really.
So they raised, what are they saying, 6.2 gross there. 6.2, and pretty extra, what, $500,000 from retail.
Yeah, that's it. Yeah. So
I quite like that chart. It's bottomed out. I think the good news, that could spike up and start moving back up, because now they've got cash. It removes any worry about that, and everything will focus on operations. So I quite like that. I think it could spike up there nicely.
Here's a head scratcher for you now. Right. Venture Life came out with trading update this week. I spoke to the CEO, Jerry Randall. Look at that for a spike.
Mm-hmm.
Now the reason is because basically they're a healthcare company, healthcare products business, largely to consumers, and they make good, sort of gross margins again. Lots of recurring revenue streams or repeat revenue streams, so to say, and their own brands have been growing even faster than their distributed brands. Their own brands now account for, I think it's around about 60% of the portfolio. They've been generating a shed load of cash. They've integrated the acquisition they did over 12 months ago, and everything's tracking up. And they've made good growth, largely on volume, which is really impressive. Because if anything, in most consumer sort of healthcare products, it's all been pricing, so they've really done well, and they've had nearly 9.5 million of extra cash coming in, despite having paid 3 out for their as a finalisation payment on that potential acquisition. Gearing has now come down to, at the year end it was 1.25, and it's now dropped to 1.1 times. So it'll be, hopefully by the end of this year, it'll be below 1. and they're increasing, their listings with UK retail, well, basically with retailers and grocers, and likewise, they're doing lots of innovation and growing online as well, really, really well through Amazon. So they're doing everything right, innovation going okay, increasing distribution, and they've got good repeat revenue streams. So they're just trading at too cheap a valuation. Before the announcement, they came at about the low 5 times EBITDA, and now they're probably trading at about 5.5, 6 times EBITDA. But this even on a modest valuation of 8 times EBITDA, it'll be 60p, and I think the house broker's got 68 on it. So it's tracking up and doing well. The management team has delivered, so great. Considering,
but do you know what? I mean, if you look at that RNS, there's 3 things happening there that's very positive. First of all, top line growing, margins improving, and so the cash conversions get better. Cash has gone up, but also debt is coming down. So it's 3 very good positive metrics, isn't it?
Yeah. And those forecasts were put out, sort of 12 months ago, and they've hit them but to the nail. So, given we've had a mini banking crisis in between, the Middle Eastern crisis, and China slowing down, then you've got to tip your hat. Actually, they've done really well to do that. So, hey, I've now highlighted them many a time before, but this is just wait. It's a coiled spring and it's waiting to go up.
Mm-hmm. Yeah.
Another one on the software that's came out with a trading update. This was FADEL Partners, which basically does. They're one of the world's. Well, they are the world's biggest, I'm pretty sure, software developer for royalties, rights management, brand compliance type software for really big brands. People like, sort of like PepsiCo and Philip Morris and Sanofi and people like that, and they help companies not only, sort of protect their visual rights across the internet, as making sure people don't rip them off, but also check people who have got sort of like who are licensing in rights to make sure that they comply with those licenses. So you've got Kimberly-Clark and you've got Hasbro. I mean, their roster of blue chip clients is absolutely fabulous. What really stood out of this one, and it didn't really, you could see it, the revenue is basically up 10% year on year, which is absolutely fabulous. But they did over 9 million of revenue in the second half. And that, it's really sort of, it's just turbocharged. And 80% of this revenue now is recurring as well, of high value. They're still investing in their growth. And I interviewed, and again, I would highlight to investors, have a look at the interview. I interviewed the founder and CEO, Tariq Fadal, okay? And he came out with an incredible stat. He reckons out of the rights royalty management business, they've got about 28% market share. I mean, this is just growing. Just think on the internet and on AI, etc., going forward, the amount of people's images which are being sort of like ripped off. Then these guys could absolutely do a brilliant service for massive. I mean, just take, for instance, Taylor Swift, okay? We know and what's happened with her with Twitter, where somebody's basically put her head on a nude body, and she's a multi-billion-pound asset herself. Never mind a lovely lady and a great sort of singer-songwriter. She's coming into the Super Bowl in a couple of weeks with her boyfriend Travis Kelce, and she's got to protect the rights. I mean, what an opportunity maybe for Fadel to sell the software just to her to protect her, because she's had a terrible time, really sort of like sledged on social media, and that could be perfect. But anyway, the software that they really are sort of like reached an inflection point. They should grow 20% plus top line, and coming up to sort of EBITDA break even by the end of next year. They'll actually generate money in 2025 as well. They've got $3 million of cash at the end of the year. And they'll only burn a small amount this year, probably 1.5 mil. So they've got enough to get them through on an organic basis. This one should be valued at 4 or 5 times sales, and it's currently on about 1.6. So, hey, put this one in your stock watch list, because this one's a really, really good quality asset with world-leading technology. I mean, he also actually, which is really interesting as an example on the interview, and again, have a look at it, guys, because you get the juice from the guy on the street, sort of stuff. And he basically said to me that they had a runoff with one of their biggest clients, and the client said, right, okay, let's test your software against best in class PR agencies and see what they can do. And they wanted to sort of like look at who was actually, sort of like knocking off their brands online. Within 5 days, FADEL came back and said it's been copied illegally 500,000 times across social media. Here are the instances: 1, 2, 3, 4, all the way up to 500,000. Yeah. 3 weeks later, the PR agency came back with only 70% of it. They'd put an army of people onto the opportunity. Yeah. It cost the client enormous amounts, and they didn't actually pick up on 30% of the the impersonations. I mean, not only was it much faster, it was much, much cheaper, and it was more extensive. I mean, you just couldn't get a better selling opportunity. What a case study.
That's very interesting, actually, because it's like, again, we are in the era here of AI and fake and fraud and all that stuff. So you can see that market only growing, and a brand is worth nothing if you can't protect it. So it's as important. The building of a brand and the protecting it is as important. So and
Justin, you could be a customer, mate. Your brand. Protect stock pickers from people like me ripping it off.
Yeah, no, I'd welcome someone ripping me off. It'll give me more traction, maybe. But it gets a certain level where you don't want that traction. Anyway,
another one. Go on. Yeah, another one which is really worth speaking about, and because we've talked about it a lot already, is Supreme. What happened was basically last week, I think it was, the government finalised their consultation on vaping, and Supreme are an FMCG sort of like business in the UK. Vaping's their biggest division, but they also do lighting and batteries and sports and health and nutrition. All of those businesses, the other ones, are doing great, and vaping is also growing. Anyway, the government, what did the government say? It basically proposed to ban disposable vapes and to further crack down on underage vaping. And that took the industry down, okay? Now, one of them, a much smaller company, don't bother putting the chart up, but you got Chill Brands, which does vaping devices, Their shares went down over 30% in the day. Supreme shares went up 10% or 20% on the day. And the reason is because all these measures had been anticipated and already, preempted by Supreme. They'd put those regulations in of, stopping underage vaping. They've also put in recyclable bins, and they've got a sort of like a stable of reusable and sort of vaping devices. They're called pods, etc., where you can put the vapor in. So they'll be impacted on disposables, but overall it's very positive because they're best in class in terms of meeting all these regulations. And and then they came out with their trading update, and they were upgraded again. So they've got 225 million and 38 million of EBITDA, etc. So
doubling, from 23,
and they're generating.
But you know what? I did comment on this on taking stock. I said, it's two sort of junior plays in this area, and in my mind, Supreme is a supreme brand because Chill has never made money. They're doing these nicotine things, and I said, this is a company is undervalued on fundamentals, and it's only the regulation that's suppressing the share price. And it's quite funny. Chill Brands come out early in the morning. They took a massive knock, and I think Supreme sat back, looked at it, and said, "Well, there was no problem. Let's look through the forecast. It's not going to hit us, really." And I think about it went up, and I think, as you can't compare the businesses because Supreme is a proper business. Chill is, I don't say making any money. Tory hasn't made money for years, but
and the valuation, even though it's gone up, is still very cheap. It's about sort of less than 6 times PE. As I say, they've got, probably got cash in the, as in like net cash now on the balance sheet because some of the, the working capital for the Elf brand has probably unwind. They're paying over a 4% dividend yield, and they're suggesting for next year actually they've held their estimates because at the moment they still believe that overall, because they're ahead of the game in terms of their vaping pods and stuff like that, plus they'll get as that'll have to be put into the distribution, then essentially they've kept their forecasts unchanged at all. So they're very cheap, and they're run by another cracking guy, CEO Sandy, and he's doing a fabulous job. The whole team's doing a really, really good, innovative. Plus the sports and wellness side is growing as well, which is again their own particular brands. And
do you know what's going to happen though? And also, do you know what's going to happen? I mean, these Elf bars and what is it, Lost Mary's, whatever, they're made in China, right? Yeah. China, they're amazing manufacturers. If they understand, the market's going to be knocked because they can't recharge them. it won't take, it'll take literally a couple of months to put chargeable ports in them to make them more sustainable. So they last 5 days rather than 1 day. And literally it won't affect them. It won't. They'll adapt very quickly, you know?
Yeah. And if you think about it going forward with reusable pods, etc., then it's going to be that razor blade razor model, isn't it? It's going to be sort of like you buy your pod and then you fill it with your vaping, and they'll make more recurring revenue streams and higher gross margins, and you can easily see how that's going to work well. And in fact, they're so confident they've started a stock buyback as well, so it all looks good for for the shares, in my view, anyway.
Cool, more stuff. Oh, shall I tell you a stock I bought recently? It's quite a sensible one, actually.
Yeah, is it?
Yeah, in fact, yeah.
What did you buy?
Sensible. I bought Ramsdens.
Oh, yes, very sensible.
Because when saying that, it is a micro cap. It is the results from things. 60 million market cap, enterprise value 55. It's nice volume on it. But they had a record performance this year, 10 million pre-tax profit, and they literally have 160 shops. They do pawnbroking, FX, gold thing. They've done these launch sort of websites, which is nuts. And the website traffic is doing very well. I thought they're a bit behind the curve. They've revamped one website, but they're just launching websites. They realize, they're getting good traction on the website. So, didn't you realize this before? But they got 160 shops. And literally, they've realized that there are about 350 locations with 30,000 population that would support them. In fact, they've got shops in towns of 15,000. So there's a lot more, but they're 160. And literally, within 4 years, they're generating good cash. But I think, they were literally, they're turning out about 8 and 12 shops a year. They're doing 9 shops this year, but it's a cookie cutter model. And I just think, I can't see, the cost of living crisis is still with us. About 300,000 people a month are going into higher mortgages, and I think it's going to knock. I just think it's a great little model. It's going to be, look at that, look at the growth for interims. Growth here, top line, 27%. Value, like I said, PE of 8, EV, EBITDA 4. Health, very good. Look at cash, 5 million. And they generate 10 million of pre-tax profit this year. And there's a record. And I'm thinking, okay, it may go up and down, but I think just this model and just rolling them out nicely.
What's the chart on it?
The chart, that's the one thing. It's rallied strong. That's rallied strongly. And
I love it. I love it.
Listen to this. It's rallied strongly, right? So I preempted. I thought this is going to rally here. It's going to break this, but we're in a range. They pay. They literally.
Sorry, how is that in a range?
I'll show you now. Dividend, right? Covered 5.46% dividend.
Yeah,
that is cracking, isn't it?
It's
for a little company. Yeah. But anyway, listen.
So how's that in a range?
Well, look at this. See, this is dipped down here before. Dipped down here. In fact, today has gone down. But it's just.
So how's that in a range?
Well, it's breaking down the range, but it's one of those stocks where I got to admit I didn't buy this correctly. I was so enthused about it, but again I haven't gone big on it. I was so enthused about it, thinking they can just roll these out, keep rolling them out. Yeah. It's literally, it's almost like it's not like they're going to unknown territories. They know exactly where they're going. They're doing 9 this year. They'll do the 9 and 12 every year until they get about 350 locations, pretty much.
Put the longer term chart on it. Put a 5-year on it.
Yeah, so it started IPO'd in I think 90 pence.
Yeah, okay.
Back in 2017.
Yeah.
COVID dashed a crash. Obviously,
all the shops closed.
Took it out. But then look at that trend line there. It'll revert to trend sooner or later. It's just, it's gone very well in the last few years. I'm probably in a bit late. I'm not late this time. I should have waited a little bit because I thought it was going to break this range. See previous highs. It didn't. It came back down. But I think the ex-dividend date is halfway through this month. But
I personally, Justin, I think that is a cracking purchase. Okay, and the reason why I do is because clearly a big part of the country is still struggling to find almost like emergency funds. Their pledge book is doing really, really well. I mean, there's a number of different factors, but you've got obviously a lot of people on lower income who need to sort of like to get some money to help them for a holiday. But equally, there was really quite an interesting article in the FT today saying that the higher level, or the higher income bracket, is also struggling to get liquidity, particularly in terms of being able to sort of, if they want a skiing holiday, school fees, medical costs, or just they just need, they're looking to sell their second homes or overseas, and that's obviously the liquidity at that market it's knocked down, and so they're getting a lot of very well-heeled people coming off off the street who are putting in their Rolexes and putting in other valuable jewelry and paintings and cars and stuff like that to get short-term loans, because these guys they're very, very wealthy net worth, but they haven't got liquidity and therefore need help by people like Ramsdens and H&T. So hey, Justin, I tip my hat. I think that's a really good.
No, I think gold price. You know, it's like. I mean, and also listen, interest rates coming down, gold will rally. People just sitting around with gold in there, and I'm going to sell that. You know, and so it's going to. You know, and this is just consolidation. Yeah, it's a cracking run from literally 2020. It's consolidation. I'm happy to pick up a 5% dividend on this. I know for a while, because I think they keep rolling those shops out. It's more cash, more profits. It's going to happen. It's I see a. Yeah, a good upside here. It's just literally, I mistimed this. I mean, me took one charts. I did mistime it. It was literally dipped over 200. Silly thing. I dipped over 200.
Okay.
It's better. And anyway, Justin, but it's fine. It's fine.
Justin, can I put the chart forward a year, please?
Exactly.
Because I think this will be over £3 in 12 months' time.
Yeah. Well,
and when you say you've mistimed it, if it's £3, it will be a blinding purchase. Okay.
Yeah, well, I see about 68% upside in it.
Yeah, I agree. I would agree.
And with a dividend, that's quite nice.
Yeah, no. I think that's a flipping damn good.
It's one of my safer plays with small cap. I see growth there. I see good value. I also see a dividend, and I see a good market they're expanding into. Like I said, I was listening to an interview I think on Sky Business, I think, with the CEO, and his head switched on. You know, it's just literally, we know what works, what doesn't work. We know where to go.
Yeah.
You know, we have a pipeline of desirable. He said the only problem, the reason why we can't expand as fast as we want to is that the pre estates we're in at the moment are not available. They are coming available now and again, and we'll jump into them. We know exactly where we want to be. And he had literally laser focus on where they want to be. So people ask me where I want to be. I want 300 stores. You know, we can get to 350 quite comfortably. I was like, right, I like this. And
good purchase. That I like that one. What about the other one which came out with results, or came out a trading update, was Lords Group Trading. Not this week, but the week before, and they were in line with expectations. But look what the shares have done. I mean, they've just been totally sold off unnecessarily. And I highlighted it they're back about 40, 42p. And now they're about 54. And again, I'd highlight to investors, have a look at the interview that I did with the CEO. And, he was very, very pragmatic. I mean, there's sort of the key they are a building products, distributor, building merchants in the UK. Plus they do heating and plumbing. And they've generated a lot of cash in the second half because a lot of the working capital, the inventory unwound with relation to the boilers they had, because obviously there's a seasonal element to selling boilers in the winter when people actually need it. They're also growing through their decarbonisation products, and it's just like they've generated a lot of cash and they're deleveraging, and they've just been just too cheap. They're a good dividend yield, and the PE ratio is it's about half of what Travis Perkins is. I think last time I looked, Travis Perkins was on about 15, 16 times PE, and these ones are about 7 or 8. So it's still a long way to go. And their real differentiation against their competitors is they've got a really customer centric, sort of like culture within that particular business, and very entrepreneurial people at the front floor who feel it and really want to do a great job for the, for their clients. So they have a lot of recurring revenue streams. About half the business is just standard sort of repair and maintenance or emergency type of stuff that people do. So they've got good visibility of the business. Yes, it's clearly not great, but with interest rates coming down, the building industry won't stay lackluster forever. And you're starting to see.
I agree with that. I think this sector is a cracking recovery play.
Yeah,
I really do. And I mean, if you looked yesterday, I think is it Berenberg? I think upgraded Marshalls or building.
Oh, did they? Okay.
Concrete. Yeah, so worth checking that out. And I think this is the house builders have gone. They've rallied already, expecting it. They've gone ahead. Now, an underlooked sector is this, almost building support services, all that. They haven't. They're still now.
Yes.
If interest rates do come down, and in fact, we're seeing now mortgages are getting a bit more popular with people. The housing market picked up. House prices picked up in January. House prices are gone, house builders. This will be the next sector to rally. And I think it's a very good sector to look at and, do your picks. I think there's some opportunities in there, definitely.
Yeah. I mean, they're basically, say they're on about 8 times PE, and they've got £15 million of also a freehold property. and they pay a good dividend. So I put the numbers through it and just did a modest sort of like, EBITDA multiple, and I was getting a fair value of 70p to 100p, but Cavendish, the broker's got 106. So there's masses of upside, and those are modest expectations. We're not talking boom time in that's sort of like, as we look at it now going forward, I think there's every chance of in this industry of people exceeding, because if you do believe that recovery in the in building activity and infrastructure and housing and stuff like that, then these guys are going to do well, and those are going to be upgraded.
Yeah,
And that's why get in before they're upgraded.
I actually think if you look at, like I said, everyone knows about the house builders. They're well known to the sector, and they've already rallied, and they've rallied because they know, looking forward, things are going to improve, and interest rates coming down. So that, and already, like I said, it's the first upgrade we've had in house prices, and so house prices, they went up by 0.7% in January. That was 7 times more than Andis expected. Yeah. That's saying to me that people are starting to buy houses again.
Yes,
now it only been a matter of time before building support services and all that stuff start rallying like the house builders do, because it naturally flows through to them, doesn't it? So it's an area that's it hasn't rallied yet. Full stop.
I got another one. We had Pfizer, which came out with an inline full-year results. I mean, they've obviously reset the bar. They got their estimates really badly wrong, and this is unfortunately a one-way traffic, and it comes down to basically, do I still think the fundamentals are in place? And I do. On very low. They've reset the bar for this year. Well, they previously reset the bar. They've reiterated expectations for 2024, and I think they're doing about $60 billion of turnover with about $2.10 for EPS, which puts them on about 13 times, 14 times PE ratio. I've just got to live with it. And again, it's sort of like, let's see what happens in 3 or 4, 5 years' time. I got it wrong, and I thought there was going to be, better product delivery and better R&D execution. Hasn't been the case. So just one of those things. Massive company. Let's wait and see.
It's early days, but that sort of bounce there. Look at that. From
Don't give me that, Justin, please. You'll wind me up.
A higher low, it's going to be all right. I think it's going to be all right there.
You're prodding me, aren't you? Again, okay.
I think we'll see. But I mean, if everything, it's like a thing, isn't it? Is it going to get any worse? If it's not, people start buying, don't they? That's
Anyway, another one which is coming out with results next week, which we've talked a lot. PayPal, okay, they've kicked out another 9% of their staff. They're making them redundant. And that's
I saw the interview with the guy saying,
did you? Chris, somebody, isn't it? Alex Chris.
He said, we haven't started yet. You wait and see what's coming. And he laid off like 9,000 people.
Yeah, I know.
I'm sure the employees weren't that impressed with that inspirational.
Now, what? I mean, I follow these quite a lot. Okay, and what's interesting is that we have had a whole lot of really, value-based, growth-based fund managers all distress selling into this. And if you look at if you actually do look at that chart, you can see that happening because everybody's thrown the towel in, and decided, right, I've had enough of this. And despite that, the shares have gone up. I mean, hey, that says to me, sentiment has hugely changed. The shares still aren't expensive, assuming that they hit it. They're going to do for this year about $5.50 of earnings. And so the shares are only on about just over 11 times PE for for this year at 62p. My instinct is saying if they can continue to grow on those payment rails out in the States, I offer them to other people like Temu and Shopify and people like that, then that top line will still keep motoring and they'll drop through because it's the good operational gearing. It just comes straight down to the bottom line. And if they can also take out a shed load of fat in the business, then the profitability will drive. So if you have a combination of increasing top line and decreasing costs, it's only going one way to me. But hey, let's wait and see. I've been wrong on this one so far. I mean, I'm not showing a profit. I've got a bit of a loss on it. As I say, I'd take it 3 to 5 years. I think they're far too cheap. But hey, a third of my selections go pear shaped. I've just got to accept it. That's rolling with the punches.
Again, though, look at this. It's never this 50-day moving average has never crossed this. Look at that. These are moving averages over 50 days and 200 days.
Yeah.
It's never crossed that. As long as that share price stays above that 50-day moving average, it will cross. That's going to go and cross. That's technically quite good. So it's, last time it did that, look at that. Last time it crossed the upside was back here in April 2020, and it went from $1.08 to $108 to $300.
Yeah.
So we'll see. And now it's $62. So in fact, do you know what? I got an alert this week, and on a company you talked about a while back. I don't know why it came out. It popped up.
Oh, yes.
He said mention Paul Hill, and I said, what's this about? And so so Learning Technologies was a good company, isn't it? And it's been taking a massive hit because they make an acquisition. Cost too much or something. And
no, a lot of it's largely on the there's a bit of that, but they've got a bit of debt as interest rates have gone up.
Right.
But it's a lot of fears is about AI, regenerative AI, whether their model's going to be impacted. You saw Chegg in the educational space getting blasted and then recovered, and so they're very, very cheap at the moment. And because they do a lot of corporate e-learning and development and stuff for big businesses around the world. Got great relationships. A lot of it's in regulatory sort of stuff, and are they going to be a bit like RWS? Are they going to be basically an AI beneficiary, or are they going to be a victim? And at the moment, the market's saying it's going to be a victim, which is classic sort of like what is the future, and taking a view about whether you think that's right or wrong, how the market's pricing it. I personally on this one, I think it's very interesting at these current levels. I could absolutely see somebody taking them out because they've got good gross margins and great technology and great and superb relationships.
Yeah, well, look at that. It's come down from what 240 down to 80 pence. It's now trying to get over that 200. Maybe it was above it, and it's hanging around there. I quite like that. If it can break that sort of 83, 84 level, that's newest highs. So
what about Destiny Pharma? They've sort of taken a bit of a bash over the last 2 days. What's all that about?
Yeah, I'm out.
You're out, are you?
Yeah. Well, I was up 95% on it, and when I get that kind of profit, I'm gonna protect that. So they came out with update on their XF73 dermal, which is not nasal is their main product there that's going for the deal. In fact, the XF platform, and they said positive things about that. But then they took what's M3, which they previously had a deal on, and they say that they're now changing the format of that, going from a liquid to a solid formulation.
Yeah,
that may take more time, but it will take more time.
Put the chart
if it goes through phase 2 again, which the Sabala, their partner, will have to fund, it'll take a long time. But they have to pay for the chemical manufacturing side of it.
So when did you sell?
I had a stop loss in at 60. In fact, all day it dropped on that news, and I wasn't.
You just sold then, just this week.
Yeah. I just sold. Yeah.
Okay, well, you've probably taken it down, haven't you?
Well, no, do you know what? I know people think that, but all day, literally, the share price was hanging around about 63, 62, and I thought that's fine. My stop loss is going to kick in there. And then at the end of the day, it just dropped further. Obviously, at the end of the day, people selling and just tripped me out. I had 2 stops in there, one at 60, one at, I think, 60, 50, 56. So it took me out of my last. I mean, it did take me out previously around like here. The majority of my thing was taken out, but I still had a nice position. But yeah, I mean, it's 95%. It's profit on that, and like I said, they are very. You've got to understand, clinical biotech companies are very volatile, and like I said, they can release news tomorrow now, and you probably go back up there. But I didn't want to take that chance of it not coming down. So
I've got to tip my hat to you there, Justin, because you've got a well publicized investment strategy. Some of it I agree with, some of it I don't, in terms of the charts and this sort of stuff. But we like to have a good debate. But regardless of that, you stick to what you're very good at, and your returns have been exceptional. And you've basically said, okay, I've made good profits, I want to protect it. And you basically said that to me numerous months ago, that on all your stocks, that's how you do it. That's how you protect the downside. And you've stuck. And when you've had the situation where it's fallen, then basically, rather than sort of like not progressing what your strategy is, what your rules are, you've done it. You've pushed the trigger. So I've got to tip my hat to you, Justin. That take guts to follow what you've said you're going to do.
Yeah, well, it's almost like I've studied in the last 2 years. I've been studying a lot what why people lose money and why people make money, and it
Mm.
comes down to two things essentially. And that's one is people hold on to their losers too long, and they almost double down on them and think believe in
Yeah,
the
no, you don't
story.
want to do that.
Yeah. And I used to do that in a bull market. I used to average down, and I
Mm.
made some excellent profits because the general market was going up. Doesn't matter, a
Yeah.
little dip here and there is fine. But like I said, in a downtrend bear market, it's not a dip, it's a downtrend. It can last for 2 years and be hugely painful and wipe you out. So
Mm.
you've got to have a sort of strategy that works in both markets. And so I think, first of all, if something dips by 20% on me, I've got something wrong. There's something not right. Because if I'm buying it exactly right, I should allow 20%. So if it goes below that, I'll probably cut. And in fact, putting automated stops in is better because if you have to think about it, you probably won't cut. And you
Mm.
probably say, no, and it can go down further. And then another thing is like, knowing when to take to a profit. And if you look at sort of, if you do like compounding, if you can do 30% on every investment you do and compound that, that's a lot of money. I'm
Mm.
not saying but it's giving the chance to go upside. So when you make a bit more profit, you loosen the stops a bit because it will have volatility. And I was trying to look at some amazing stocks, JD Sports, and looking at the amount of volatility in it. It did 13,000% from 2009 to 2021, and sometimes it went down 69%.
Mm.
In fact, but I mean, in the first 300%, it only went down by 10% from 2009. So
Mm.
trying to capture a bit of that and then not getting stopped out too early is the key. And just having that two things: trying to hold on to the winners, the ones will go on, then be winners, but also not holding on to your losers. So that's
Well, this is a
because I think
gainer for you, isn't it?
yeah,
You've made it. I mean,
yeah,
as I say, you've well publicized the system, the rules that you want to indeed run your portfolio, and then you've stuck by them when it started to go against you, and that takes guts. That does, Justin, because who knows? You rightly say, they might come out with some blockbuster R&D
yeah, they
results in
could
a
do.
week, and it could be over £1, and that would
Yeah,
gut you. You'd feel,
yeah,
oh,
yeah,
well,
yeah,
I've missed that
yeah, yeah.
opportunity, but you're prepared to be wrong again, and that's what you've got to do. It's tough to buy, and it's
Mm,
even tougher to sell. And if you
yeah.
have a system that you have and you followed it, I think only investors can tip your hat to that.
Mm,
That's well done, mate. I think
yeah.
that's good because I'd have looked at it and said, actually, the R&D is doing pretty well. I'm happy to hold through volatility myself. But
Yeah,
no, I
yeah,
think
yeah.
you've done. I think you, and then you can now reinvest the funds, can't you?
Well,
Into
exactly. I mean,
Ramsdens, into
yeah, but it's
Ramsdens.
no, exactly. I've got 30%. I think 36% cash. 36. I think
Yeah,
yeah, right, because a lot of that is sitting there. If
yeah.
my stocks are performing, I'll increase my holdings on them. If they don't, I look for other opportunities. So
Mm.
it's fine. But anyway, thank you, Paulie. Thank you everyone for tuning in. Thanks very much for that.
Any
And
more questions to finalise?
no, it's just basically, I think our initial discussion got people. What is it about? Oh, can Justin? I've been told before. I should mention my own stocks, but I mean, it's sorry. Can Justin talk through the SBDS tweet? I tweeted out yesterday, and it's on LinkedIn. It's 4D AI Silver Bullet. They partner with OpenX, which is a massive
Yeah,
supply side platform in advertising. And if you know about advertising, and I don't know too much,
yeah,
but I
yeah,
know
yeah.
these platforms run everything:
Yeah.
the demand side, supply side, and they have billions. Literally, they have 365 billion ad requests a day. OpenX.
Mm.
4DAI has been selected as one of their partners. So when companies go to buy advertising, they can run different programs to see how it works. Now, 4DAI in the contextual space is the first option on the drop
Yeah.
down, and below them is Oracle. So
Oh,
you
right.
can
Okay.
see how good 4DAI is.
It's above
And
Oracle.
so it's about that. It's about three companies do contextual,
Mm.
four companies, and they're the top option on the
Yeah.
actual website.
When I was a kid,
So yeah,
when I was a kid,
yeah,
used to have I watched Central Television. It doesn't exist anymore. It's part of
yeah,
ITV, and they used to have a little sort of like section every week on a Friday night with a guy called, I think it was Sean Taylor, Police
yeah,
5. Okay, and he used to say, "Keep them peeled." And the reason why I say keep them peeled is I'm speaking to a rock star fund manager on Monday, Ken Wotton on Gresham
mm,
House, who's a real value investor and active. He just
yeah,
looks at private, public. Silver Bullet Data Services is on the agenda for Monday. So watch that when it gets published on Tuesday, because that will have a really, sort of like fundamental private equity type person looking at this business and telling me what he thinks, and he owns
yeah.
it. So it's going to be, yeah. Well, anyway, what the hell? But yeah, no,
There's a
interesting.
chart there, so it's done quite well. But I think it's a huge platform. I mean, winning. If you're good in this new era of contextual, advertising and all that thing. Like I said, there's massive players in that thing, and even so that's recurring revenue for them. Literally, the advertisers will use their plugin on that site, and they get loads of revenue. But it's been a good performer. That literally, look at
You
it.
still hold them, yeah?
Yeah, all every single share. It hasn't really dipped. I mean, it had little dips around here, but it hasn't really dipped. So
Well done.
yeah.
All right,
Cool.
We've had a good debate this morning,
Yes.
and I hope people haven't had too many profit warnings like I've had. But I'm sure if you have, you know how to deal with it. Make sure you control your emotions, look at the longer term, and then
hide
decide
under your
whether you want to
duvet.
pull the trigger or not.
Yeah. Profit warning, just hide in your duvet for a couple of months, come back out. It's fine. It'll be fine. Everything's going to be fine in the end. Thanks, everyone. Don't forget to hit that subscribe button if you're good, and download the Vox Markets app. It's free, but it provides a heck of a lot of value. voxmarkets.co.uk/app. Paul, catch you in a couple of weeks, fella.
Yep, sounds good.
How do you get off this?